Fed holds the line as war, oil, and inflation corner the market. The Fed did not move. That is the headline. But stillness is not peace. Sometimes it is only the pause before a larger truth becomes impossible to ignore. We are watching a system try to look calm while the ground underneath it shifts. Oil climbs, inflation refuses to die. Cleanly, employment softens, and a central bank pretends it can balance all of it with a steady hand and a straight face. Bitcoin falls with the rest of the risk trade, because in moments like this, markets do what they always do first. They price fear before they understate. And the Federal Reserve held rates steady again, exactly as expected, and that is precisely why the moment matters. Nothing surprises when everyone has already been trained to expect indecision. The real message is not in the decision itself. It is in what forced the decision to become so ordinary. We can read this scene clearly if we stop listening to slogans and start listening to pressure. A war in the Middle East pushes oil toward $100 a barrel. Inflation data comes in ugly. Growth looks less certain. Employment begins to wobble. And suddenly the central bank finds itself standing between two fires, pretending one can be extinguished without feeding the other. That is monetary policy in its modern form, not control but triage, and you can feel it in the market response. Bitcoin drops nearly 4% ahead of the announcement, then stays weak after it lands. Stocks sink modestly. Treasury yields edge higher. Nothing here screams panic, but everything whispers caution. The crowd is not fleeing yet. It is repositioning its fear. Ask yourself something simple. When oil rises because conflict intensifies, who really pays? Not politicians first, not commentators first. It is households, it is savers, it is workers who discover that wages are always late to meet reality. It is every business forced to choose between thinner margins and higher prices. This is how scarcity enters daily life, wearing an economic costume. The Fed says the implications of Middle East developments are uncertain for the U.S. economy. Of course, they are uncertain. That uncertainty is not an accident. It is built into interventionist systems that depend on global stability while claiming domestic mastery. A central bank can print expectations, but it cannot print barrels of oil at will when geopolitics decides otherwise. There is always a moment when abstraction meets friction. This may be one of those moments. We should look closely at what changed inside the Fed's own projections, because that tells us more than any polished sentence from a press release EV. Inflation expectations for 2026 were lifted meaningfully, while later year estimates remain only slightly improved on paper. Translation: the beast was supposed to be tamed sooner, but now even official models admit it will linger longer than hope. That matters because policy lives on time assumptions. And time assumptions are where institutions often lie to themselves most elegant. They tell you inflation will ease next year. Then next year arrives with new excuses. They tell you growth will normalize. Then credit tightens and demand weakens. They tell you labor remains resilient. Then layoffs begin appearing like cracks in fresh paint. The dots still imply one cut in 2026. And another in 2027, as if reality has agreed to wait politely for their calendar. But markets know better than that very polite fiction we call forecasting. A forecast does not command event. It merely reveals what someone was comfortable imagining before events reminded them who rules whom. Here's the contradiction we have to hold without blinking. The Fed wants disinflation, but war raises energy costs. The Fed wants labor stability. Growth slows under tightening. The Fed wants credibility, but credibility itself depends on outcomes no committee can guarantee. So what remains? Delay, language, projections dressed as prudence. And while all of this unfolds, Bitcoin gets sold alongside equities as if it were just another speculative asset trembling under macro pressure. That reaction tells us something important about market psychology, but nothing false about Bitcoin itself. In short bursts of fear, liquidity traders sell whatever moves fastest or hurts least in their model of pain today, even if they claim tomorrow belongs to something more durable. That's fine. Let them confuse price with thesis for another day or two. Markets always do this dance before they remember what mattered. Because Bitcoin does not depend on geopolitical calm, Bitcoin does not require trust in committee wisdom. Bitcoin does not ask permission from an energy cartel, or a treasury desk, or a central planner, with a microphone and a soft warning tone. Bitcoin simply exists where money becomes transparent again. And maybe that's why these moments feel so uncomfortable for people who still believe fiat systems are normal, rather than fragile arrangements held to. Together by habit and coercion, your true on his sharing. When war pushes energy higher, when inflation reawakens at the edges, when growth slows and policy cannot solve both sides at once, suddenly sound more. Nay, stop sounding ideological and start sounding practical. Not romantic, practical. There's your first microhook. What happens when every temporary shock becomes permanent enough? The answer reveals itself slowly, then all at once. The system built on cheap credit discovers that cheap credit was never free. It merely postponed our recognition of cost. We live inside an economy that tries to hide time preference behind liquidity creation. But time cannot be abolished by rate meetings or model updates, or carefully phrased speeches about balance and resilience. Time collects its debt anyway, through higher input costs, weaker margins, lower real wages, tighter lending standards, and eventually through policy. Cal pressure disguised as concern for stability. Stability has become one of those words used most often by systems least capable of producing it now. Too early. Look at the vote itself. 11-1 in favor of holding steady, with one dissenting voice wanting lower rates already. Even there we see human action exposed plainly. Some participants read weakness and want relief now. Others read inflation risk and want restraint. No. W. Everyone interprets uncertainty through incentives shaped by their model of pain and reward less than through any pure access to truth. No committee escapes scarcity just because its members speak professionally about it. They choose under constraint like everyone else. Only their mistakes travel farther because their authority makes them louder than reality until reality interrupts them publicly. And reality has interrupted before, repeatedly, yet each cycle seems to renew faith in managed outcomes just long enough for another distortion layer to form beneath them. Easy money inflates asset prices, rising asset prices create confidence, confidence supports leverage, leverage magnifies fragility. Fragility demands intervention, and intervention restarts the loop at greater scale. This isn't policy, it's addiction with institutional stationery. The market knows this pattern even when traders pretend otherwise during green days and red days alike. Maybe that's why Bitcoin matters so much in scenes like this, because it forces us back into accounting rather than illusion. When fiat institutions respond to conflict by balancing narratives, instead of preserving purchasing power, honesty becomes expensive very quickly. Oil approaching $100 per barrel does more than raise gasoline prices. It acts like an invoice delivered straight into every hidden corner of economic life. Shipping gets dearer, manufacturing gets tighter, agriculture absorbs pressure downstream. Consumers feel poorer before official statistics fully admit why. And then, policymakers face their favorite puzzle. How do we fight inflation without killing growth? But we should ask a cleaner question. What if growth was already weaker than advertised because prior stimulus borrowed from future activity? What if today's soft landing language simply describes yesterday's excess finally meeting gravity? That question changes everything. Because if growth was artificially supported by years of suppressed rates and expanded balance sheets, then tightening was never going to be painless. It was always going to expose dependence. This is why rate cuts matter so much psychologically, even when they are small in mechanical terms. Markets interpret them as permission slips for risk taking rather than as genuine signs of health. A cut says, continue borrowing confidence from tomorrow. A hold says, maybe tomorrow should pay some bills first. Neither solves structural debt dependence unless underlying production strengthens faster than claims on production expand, which rarely happens instead. Are years of monetary distortion. Not equally on GTI, internet stone to tell. So yes, investors turn toward Powell's press conference, now waiting for clues about tone. Is he worried? Is he confident? Will he hint at cuts? Will he acknowledge oil? Will he frame inflation as temporary again? There's another micro hook here. If language moves markets this much, what exactly does language hide? Powell will speak carefully because his words function like bridge planks over uncertainty. He must keep financial conditions from tightening too violently while avoiding any admission that policy has limited leverage over imported inflation from geopolitical shocks. In that balancing act resume. Less medicine prescribed after symptoms have already changed shape. Now, it helps manage perception more reliably than causation, and we shouldn't mock that lightly. We should understand its limits clearly. And central banks can influence borrowing costs, and they can alter liquidity conditions. They can slow or accelerate certain forms of speculation, but they cannot legislate away warfare-driven commodity shocks. And they cannot command households to feel richer when real prices rise faster than wages. And they cannot transform debt saturation into abundance by optimism alone. The last point matters most right now. When assets rise, on easy money people mistake nominal gains for wealth. And when rates rise, those illusions in out fast. Anwar adds fuel costs into an already brittle structure. Nominal numbers become less comforting because lived experience starts diverging from official reassurance. And this divergence creates political danger almost immediately. And people don't revolt against percentage points. They react against groceries, fuel, rent, insurance, utilities, all arriving together like synchronized reminders that money no longer means what it said. Last year, envy. From there, indignation grows. Why are prices up again? Why do wages lag? And why does every institution promise moderation while delivering instability? And why do officials call this transitory after repeating similar errors under different names? And because admitting structural failure would force a reckoning with monetary design itself. And design flaws are rarely confessed until consequences become unhideable. SEB is cool. T-Coin stands outside that confession process like an unblinking ledger. It doesn't need anyone's approval cycle. It doesn't care whether WO are scarce markets or whether committees prefer gradualism. SSS. Its issuance schedule remains fixed, while fiat systems improvise around endless continuum. Agencies, ITS. So that distinction may sound technical until you realize how moral it becomes during stress. In times like these, people rediscover what sound money really offers. It's not excitement, it's not quick rescue, not guaranteed profits, but clarity. It's clarity about savings, clarity about deep illusion.sl. It's clarity about who bears risk and who quietly transfers it elsewhere. Fiat hides transfer mechanisms behind complexity. Is Bitcoin exposes them by refusing participation in arbitrary expansion. OASS 1.3c. Only if your advantage depends on opacity. Maybe that's why. Some still dismiss Bitcoin whenever volatility rises alongside stocks. Surely if it's down today, it's just another speculative toy. Surely if it's hold off during macro stress, it's no different from tech shares. And surely all scarce things must obey short-term panic before long-term recognition. Arnon said yes, short-term price action can mislead impatient observers, but mispricing doesn't erase monetary properties. It delays their recognition among those trained by inherited narratives, rather than direct reason on gold once lived through similar dismissals. Internet infrastructure. once looked unnecessary. And any innovation that threatens old coordination structures tends first to appear dangerous, and later obvious, and finally inevitably, and that's human action. On our repeated sequence where usefulness arrives silently, and the crowd resists noisily, and untruth wins by persistence. Rather than applause and notice something else. Want the Fed's own dilemma proves why hard assets matter more during conflict-driven inflation episodes. S&F energy shocks lift headline prices while growth slows. Not policymakers confront stagflationary pressure, not condition, where neither easier money nor tighter money feels clean. Each choice carries pain somewhere else, and cut too soon. Inflation credibility erodes further, and hold too long, and employment and weakens more sharply, knees aggressively. You risk reviving price pressures just as households suffer high essentials costs untighten aggressively. You risk breaking credit-sensitive sectors already under strain, and so, where does certainty live? It doesn't, yet markets keep demanding certainty. Anyway, because uncertainty feels intolerable until reality teaches otherwise. In this tension between craving certainty and living inside uncertainty explains almost everything about modern finance. Everyone wants stable rules, but few want stable money enough to accept discipline upfront, and everyone wants slow volatility, but many still chase leverage, and everyone wants safety, but most reach for assets priced on someone else's promise, and Bitcoin interrupt as that habit with rude elegance and a protocol, instead of promises, and a schedule, instead of discretion, and a settlement layer, instead of narrative management. And yes, NIT remains volatile in market price, because humans are volatile in behavior, but volatility around a fixed monetary asset differs profoundly. From volatility inside an endlessly expandable one, whose unit itself erodes quietly over time. Here's what many miss: a falling Bitcoin price story. Risk-off episodes doesn't automatically weaken its monetary thesis. It often reflects temporary liquidity preference under stress. People sell what they can before they sell what they must. Understand, that's not criticism. It's anatomy. The deeper question isn't whether traders panic, it's whether and if anything else offers stronger long-term protection against dilution administered through policy response cycles. Look back at today's environment. Bank holding steady, inflation expectations creeping upward, oil near levels that squeeze real activity, stocks slipping, treasuries twitching, Bitcoin absorbing short-term selling pressure. This isn't random noise, it's coordinated revelation through multiple assets telling one story. Capital fiat. RS persistence, more than movement, because movement alone isn't dangerous. Persistent erosion is persistent erosion. Destroys planning horizons. Persistent erosion punishes saving. Persistent erosion rewards debt over prudence. Persistent erosion trains society toward shorter time preference until every asks only what's available now, rather than what's sustainable later. And there lies one reason Bitcoin resonates so deeply. It restores seriousness. Round time, each block confirms work. Each halving reminds us scarcity isn't negotiable. Each wallet reminds us custody matters more than slogans. Each slogan a left-held key turns ownership back into responsibility instead of outsourced trust. That's why our closing thought keeps returning here. When institutions respond to conflict with managed language, while citizens absorb unmanaged price increases, the search for durable money stops being theoretical. It becomes intimate. You feel it at the gas pump, at checkout, in rent negotiations, and portfolio drawdowns caused by shifting expectations rather than lasting value loss. You begin seeing how much normal depended on hidden subsidies from easy credit and global calm. Then history introduces friction again and on. Everyone pretends surprise, though nothing fundamental changed except honesty entering prices. So let Powell speak carefully later today. Let analysts parse every pause, every adjective, every pivot phrase. We already know the structure underneath. War disturbs energy. Energy disturbs inflation. Ion constrains policy. Policy struggles with credibility. And markets search for refuge wherever scarcity cannot be printed away. Some will keep chasing G yield inside fragile instruments, promising comfort without consequence. Some will keep trusting institutions whose tools create part of the problem they're hired to solve, and some will quietly move toward assets whose rules don't depend on speeches being convincing. That difference matters now more than ever, because when pressure rises, truth separates faster from theater, and once you see how quickly fear travels through paper promises, you, Saint are understanding why hard money survives every era differently. Not because it's exciting, because it's indifferent. Indifference can be strength. And everything else demands belief. The question isn't whether today's hold rate decision calmed anything. The question is whether people notice how much calm had been borrowed all along. We are block sonic. We don't predict the market, we read its memory. Never forget. Bitcoin is only yours in your call. D wallet.